Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Huang. And we've got a bit of a lackluster session last night. Stocks slipping as the big tech rally in recent days has lost steam, and the S&P 500 has ended a 6-day winning run. And that's seen the broad index down 0.4% to 5,940. The Nasdaq Composite also down 0.4%, and we've got the Dow Jones Industrial Average losing over 100 points at 42,677. And to help us navigate what's coming up and to make sense of the markets, we've got Rodda. He is the Senior Financial Market Analyst at Capital.com. Carl, good morning. How are you doing today?
Good morning. I'm doing great. Thanks for having me.
Always great to have you on. Let's get help first to figure out what is driving the sentiment right now with markets down.
Well, I think we've lost basically fresh news catalysts to keep moving the market higher. I don't see that there's necessarily any greater pessimism out there. And I think if you look into the grander scheme of things, there's still hope that trade deals will eventually get done. The pause on tariffs between the US and China, and obviously the US, some of its other counterparts, will eventually turn into a trade deal and, a permanent sort of ceasefire, if you will. But really, I think it's, you sort of said loss of steam. It's obviously a loss of momentum, and that sort of momentum has stopped because investors have simply no longer got fresh news to buy into. So for now, we're kind of consolidating, taking pause in this rally, really looking for the next reason to buy.
Yeah, how much do you think the news around the debt downgrade for the US when it comes to the credit ratings from Moody's played a part in this current climate?
I think it was a little bit overstated, and I think if you look at the price action and the long end of the yield curve at the start of the week, it kind of tells you everything that you need to know, that there was a knee-jerk response initially to the news, and quite naturally that's normally what happens when a big headline comes through. But in the grand scheme of things, Moody's didn't tell the markets anything new. Their argument was effectively that the US fiscal policy remains very loose, deficits are going to increase, and therefore the debt load is going to increase. And their argument is that that'll impact serviceability. Is that concerning? Maybe. Is that new information? No. So, the markets kind of looked through that, especially given it's a fairly long-term and structural question. There is still this element of, what this fiscal package will be in the United States and how that will actually impact public finances. And that's a more relevant, live and ongoing question with some degree of uncertainty. But I think really, we won't be talking about this Moody's downgrade very much in a few weeks' time. If anything, it was just a little bit of a signal that, of information that was already basically baked in.
All right, in terms of corporate news, we have Elon Musk. He has affirmed his commitment to lead the EV maker for the next 5 years. And on that, we've seen Tesla shares up 0.5%. Any thoughts there in terms of where Tesla's going?
Yeah, well, it's a good thing for Tesla. And depending on your political views in the world as well, it's probably a good thing for a lot of people, just on the basis that, hopefully it'll refine his focus to his business interests and his area of strengths, rather than becoming just sort of distracted with other sort of frivolous things. But, for investors, there has been concern over the last 6 months, if nothing else, maybe even a bit longer than that he's sort of taken his eyes off the ball. Obviously there are fairly significant problems that Tesla, challenges that Tesla faces from, narrowing margins. That's coming from greater competition from obviously EV makers, especially in China. But obviously there's, disruptive forces all around the world. In the last, say, 6 months since, he's been a big player in US politics, there's been issues around brands and how that's sort of translated into, potentially risks to market share and lower sales as well. So the fact that we've got him potentially focusing his efforts on the company rather than other things is good, just from, basically his mental energy is being directed to the company, and maybe sort of de-risks things a little bit as well by sort of taking him away from the political spotlight.
All right, let's switch tracks to currencies right now. We had the Reserve Bank of Australia yesterday with what's been described as a dovish cut, widely expected. What is the reading here with that move? What are they telling you about the outlook for the economy? What are they thinking about China? What's going on with tariffs? What is the takeaway here?
The takeaway was that they're concerned about global risks, and you could see it in their forecasts, you could see it in their language, and that was really the only kind of meaningful thing to have changed since the last meeting that, could really describe effectively what was a mild pivot. They went from a fairly neutral tone or sort of a wait-and-see attitude, assessing kind of, both sides of their mandate, the balance of risks to it, to, more or less emphasising that growth is going to slow down. The unemployment rate will tick up a little bit. And, fortunately as well, inflation will be a little bit lower as a result because, growth will be weaker. So, the market's now really sort of poised for a few more rate cuts, maybe as many as 3 before the end of the year. And, effectively they've reframed the conversation about monetary policy from here, from one about inflation and two-sided risks for the economy to one which is, very much focused on how the Australian economy is likely to slow because of global uncertainty and the weaker global growth that will generate.
All right, and the Aussie dollar under some pressure following that latest move by the RBA. Also under pressure in recent days is the US dollar. Looking at the dollar index, we are seeing the USD down for the month by over 1.7%. Year to date, down nearly 8%. What do you make of where things are going for the greenback? How much, weakness is there?
I think there's a major trend to the downside playing out. You could kind of argue at the moment that maybe there's positioning that needs to be sort of worked out after that kind of big move in April. But, if you do look at kind of the technicals, they're looking fairly bearish. And, there's two elements here. There's a cyclical story and there's a structural story. The cyclical story is that, the US is running trade policy that will ultimately be negative for economic activity. The second part of that is a structural one, which is to say that there is a level of loss of faith or loss of confidence in US assets because of the kind of crisis of confidence that was created by US trade policy. And now investors are more or less looking at ways to diversify themselves away from US dollar assets at the margins. Obviously, it's still going to be the core of the financial system. There's just a little bit of a move away from it. So I think on the basis of that, especially if we kind of don't get the high tariffs that we were talking about a few months ago, just a moderate level of tariffs that are likely to slow growth, it probably means it's a little bit easier for the Fed to cut rates as well, perhaps somewhat ironically. But yeah, in the grand scheme of things, there is that kind of de-dollarization push, a lower demand for US assets, and I think that's still to sort of play out in a weaker dollar as we move forward.
Yeah, Carl, how much do you think the US dollar has lost its attractiveness as a safe haven currency, especially against the Japanese yen? I
think everything works at the margins, right? So, at the end of the day, what we're talking about is, not just probably the dollar system, really it's the treasury system. It's the treasury that sits at the core of everything in the financial markets. It's kind of the bedrock that holds everything up. And there's nothing going to replace in the short term US treasury and the role that it plays. However, if we do look at the margins, clearly there's a little bit of a crisis of confidence in treasuries and in the dollar by extension. There's nothing as deep and as liquid as that market. But basically, surplus countries are going to be looking at ways to try and reduce their reliance on the US Treasury, both because they have less confidence in, obviously the US honouring its liabilities, but also, a lot of adversarial countries like China don't want to be helping subsidise lower interest rates in the States. So there's going to be a move to sort of diversify these reserves into other assets. And that's when you start talking about perhaps Japanese safe havens, you talk about, Swiss safe havens, you talk about, European bonds in particular. So again, it's not going to change the fact that the dollars or the treasury is at the core of the system, but at the margins, it's going to reduce that kind of exposure that investors have to it. And that's why, again, I think there's going to be kind of a bit of weakness coming through the dollar as that kind of marginal change plays out.
Yeah, talking about safe havens, Carl, let's look at gold, and that's where it's been on a pretty good run. Year to date, up over 25%. It looks like a pretty good year so far for gold. Where do you see things going? How much more upside is there?
I think there's a lot more upside. I was thinking that there might have been a deeper pullback, perhaps sort of the low threes, high twos, just because we have seen some progress being made on trade deals and things of that nature. And there was obviously such a big impetus there for gold from trade frictions. But if you look at the price action last night, we fairly meaningful breakout. Dip buyers really, defending that 3,200 level. And then again, if you sort of look at, that's probably the cyclical story a little bit there. If you look at that structural story, it's basically the flip side of the US dollar. Investors are looking for it, and obviously the Chinese, but this is going to be increasingly true for other major players in the market. That they're looking for things, alternative stores of value that isn't the US Treasury, and flows seem to be going into the dollar as a result. Again, China's a big one, but that's going to be a story that's going to play out for other central banks and other money managers as well, who want to, basically find diversification in their portfolios. So I think the long-term story is really, really bullish. The cyclical story is supported as well if we sort of consider that growth slows down, rate cuts come, dollar weakens, yields maybe a bit lower at the front end. Again, it all lined up very well for gold.
Yeah, lots of tailwinds for gold, and it's now trading at around $3,300 per ounce. And for the year, up 36% for the past 12 months. And we've been in conversation with Rodda. He is the Senior Financial Market Analyst at Capital.com. Carl, thanks so much for your time and insights this morning. Always great chatting with you.
Thanks for having me again.
All right, catch up with you again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.